Hi, everybody. My name is Phil Blancato. I'm CEO and President of Latimer Endowment Asset Management, Chief Market Strategist for Jose. I have a special guest today, my buddy Mike Gitlin. I'm going to have him help me out in just a second. I'll just give a quick market update. You know, I love having guests on. Mike's a dear friend, someone I've gotten to know very well. Just real quick, what we saw last week in markets, and Mike will have this a little too, was a surprise around inflation, and that we're still continuing to see some of the data suggesting that things are getting a bit expensive out there, but honestly, not because of oil. There was a real weird thing that happened last week. In the calculation of what makes inflation hotter, core inflation, rent is 60% of it. And when you kind of peel that back, why was it so high for the year over year, month over month? Was because the way it's calculated was had an error in it in the fall of last year. So it was a month where we had zero rent increase. To fix the zero rent increase, they adjusted for it last month. So while it looks like the headline number was much higher, it really wasn't because of oil yet. Now we've talked a lot about oil. Oil above call it $120 a barrel might be problematic for long-term markets. But for now, the S&P 500 as of this morning up a whopping 8.7% on the year. I mean, that number's kind of incredible. The bond market, unfortunately, now flat to down 0.71. And the kind of the story really is where the market was so broad at the beginning of the year, it's got a bit more narrow. The winners on the week clearly were names that we've talked a bit about, but haven't seen where we saw Russell, the Russell 1000 value for the week was down 0.76, and the Russell 1000 growth up 0.66. What's worked? The NASDAQ. Things like the NASDAQ are just ripping higher. The NASDAQ now up on the year, believe it or not, 13%. What's really interesting when you think about where international's been, we really like the international space, only up 6.23 now, trailing the S&P 500. What does this all mean? Right now, you have tremendous earnings growth, double-digit earnings growth for the first quarter of the year. And that's really kind of spilled into this idea that the market has really rallied. But it's been all about tech. And then more importantly in tech, as of late at least, more importantly in tech, it's been about the chips and where the chips are, who's making the chips, where the chips are going to be sold, who needs them. And then it's the picks and shovels of AI, the other parts of it, the Cornings, the Caterpillars, the Cummings of the world that are providing power or resources. That's where the market's been in a tremendous rally. I'm going to stop there today. I have a good friend of mine on. How you doing, Mike?
Good. Bill, thanks for having me.
I'm glad you're here. This is fun. So a little bit about Capital Group is where Mike is the CEO of, and certainly the biggest and most formidable mutual fund money manager in, I'd argue, the world. I'm going to leave the other firms out of it because I don't think they do what you guys do. Maybe a little bit about your background, a little bit about your firm.
Yeah, so Capital Group, thank you, by the way. You guys are awesome partners to us. Capital Group, largest active manager in the world. We manage $3.5 trillion. It's all active. There's very, very little passive and alternatives that we put into some of our solutions, but it's 99.9% active. We've been around for almost 100 years. We celebrate our centennial in 1931 centennial in 5 years. And we're focused on beating competitors and beating benchmarks, not necessarily getting involved in any other hobbies other than managing people's money for the long term.
I mean, that's probably why you've been so successful. Trillions of dollars under management, a tremendous track record. I've got a chance to see how the history of the firm's come together. But you are unique in that, we meet people who are, titans of our industry, and I know that's a big word, but you're just a regular guy. It's one of my favorite things about you. I enjoy seeing you. Maybe a little bit about your background and where you're from.
Well, I'm not that complicated because I'm not that smart. I mean, I majored in history. Everyone who works for me is a lot smarter than I am. I grew up in Connecticut. Went to Colgate University, majored in history, became a trader very quickly.
A bond trader, right?
I started off as a stock trader and then became a bond trader. So I started off trading in the early 90s, did that in Connecticut, New York, moved to Asia, lived in Hong Kong and Singapore, worked on the buy side, the sell side, international, domestic, hedge fund, long only. So lots of different things, stocks, bonds, lots of different things over the last 33 years. I like to say, people say, do you have any regrets in your career? And I say, I got the Capital Group too late. I got the Capital Group in my mid 40s instead of my mid 20s. It would have been better to arrive earlier, but it's been an interesting career.
Well, you're obviously very good at it. You guys come from a great firm. It's an honor to have you on today.
Thank you.
Well, let's just talk about your weekend. We have a little segment in the beginning. We talk about weekend. So my weekend was, I got to run in the, well, it's a long story, but I did a 10K this weekend in Cleveland, Ohio with my dear cousin, Jason Gillis. He's married to my cousin out there. He's kind of a hilarious guy. He's actually one of these boom bust people. He's busted 3 times in his life, and now he's in the business of mold restoration and absolutely crushing it. He sells all these. If you know anybody's got a mold issue, let me know. I got your guy.
You got your guy in Cleveland?
He said stuff all around, all organic stuff, and he's running around the whole country with his hair on fire. But he wanted to run a 10K, so we went out. We ran a 10K this weekend. And we finished in 1 hour and 12 minutes. We walked a little bit, but we got it done. We had a lot of fun. What did you do this weekend?
Well, funny, we were chatting. I did a 5K this weekend, and I did it with my daughter and her boyfriend in New York. It was the New York Police Department Memorial 5K on the Lower West Side.
Okay.
And we were going to run it slower, but I got a little competitive, and we ran it faster than I wanted. That's why I hobbled in here this morning. But we did it in 24:50. And for Sophie, that's very easy because she's a runner. For me, at the end, I thought I was going to need some of the police folks who had run the race to help me revive, but I was okay. And I made it through.
That's fun. Good for you. That's good stuff.
It was fun. Yeah, it was fun.
That's good stuff. Well, we both had fun weekends. By the way, it finally got warm. Now, the gang who listens to this podcast know this was a big time of the year for me because they're planting a lot of tomatoes. We have a whole conversation with folks who listen about tomato sauce and tomatoes and gardening. It's a big thing on this podcast. It's a very serious thing.
Are half the listeners gardeners?
Pretty much. Well, I just think they really like Italian tomato sauce. So for those of you out there in tomato world who care about how you garden, I had to wait because it's been so cold in New Jersey. The tomatoes did get in the ground on Sunday. My nephew Mark and I planted 74 round one. And we got to do a couple more this week. We'll probably get to 115. San Marzano, Roma plum, and a Sicilian kind of blend. So
you got to save me some of those when I come back.
I got a gift for you.
All right, good.
You get a little bit of
don't get ahead of the gift.
All right, so let's have a little fun. You guys are known for the ability to cover multiple markets, equities, fixed income, and in a minute we'll talk about alternatives. But in your role, I give that quick little market update. What do you think we are in markets right now? There's this thing happening, and I'm so glad you're here because it's a great way to segue. The bond market's telling us one thing, the equity market's saying there's another thing. I believe the market was going to broaden out this year, and it started that way, and then it got narrow. What do you think we are in the state of things right now?
I think you have to think about it both short term and long term. I mean, short term, the war has moved oil has moved inflation. People are worried about higher prices and people are worried about stagflation. Is the inflation picture going to get out of control to where growth slows down materially? I think that's what everyone's worried about. That's not rocket science. I think the short-term conversation, though, gets so misplaced because think over the long term. And I'll share some facts with folks just to put things in perspective. I won't make it a quiz, but in 1980, US GDP was 3 trillion. In 2000, it was 10 trillion. Today, it's 32 trillion.
Yeah.
And in 2050, if you assume somewhere around 2.5% growth, will be about 60 trillion. So if you believe in general that economies grow, and you look at the S&P 500 very close to an all-time high, the only reason you'd have a lot of cash is you have a very strong view of your own capabilities to do market timing.
Yeah.
I mean, otherwise, you just go through these periods of noise. We're in one. There is a war. It is impacting oil. It's impacting trade. It's impacting growth. U.S. was on track for 3% GDP growth.
Yeah, we were crushing it.
We're probably closer to
I spent time with one of your economists. We had that conversation. Yeah. Oh my gosh, I'm forgetting his name right now.
Daryl Spence.
Yes, thank you. And
another bald guy.
Yes,
like Ryan.
Smart dude. Yeah, like that guy. A smart dude. What was cool about it, we talked about maybe this expansion of manufacturing would get us to 3%. And then we ran into
the economy, by the way the economy is structured with deregulation, there is a chance the U.S. can sustain higher GDP growth.
What we need is to balance out our deficit, right?
We have to balance out our deficit. But I would just say in the near term, there's going to be some market noise. Yields are higher because people worried about inflation. The market's been more volatile because people worried about the war. And this is all tied together. So I think you'll have some volatility in the near term. At its heart, earnings are growing. You said it. Yeah. Earnings are up 20%. People thought earnings this year would be up 12, 13%. They're up over 20%.
Margins through the roof.
Margins are through. And by the way, very simply, again, for me, not everyone listening, AI is going to make companies more profitable. and more productive. So if companies are going to be more productive and economies generally grow, you have to be invested through the volatility. There'll be some noise, and there has been recently, and then the markets recover because people get the longer term picture that companies are simply going to be more profitable.
Do we get a broadening out of the market finally on the equity side? We've been waiting for the small caps rip to start the year, and now they're still doing great. Don't get me wrong, but we went back to the same old story of the narrowness of the market.
But you get these, it's sort of like an accordion, but I think you'll have extended periods of broadening. I mean, you talk about small caps, the Russell 2000 is beating the S&P by 500 basis points right now. 400, 500 basis points.
You're absolutely right. Russell 2 on the year is up 1299, beating the S&P at 870. So yeah,
400 basis points. So you're seeing that broadening. International, some parts of international have pulled back, but you look at Korea, it's up 80%. Taiwan's up 40%. Japan's up 20%. So the opportunity to pick stocks around the world is still very real. The opportunity to pick small and mid caps outside of the biggest 7 companies in the world is very real. Opportunity to participate in dividends. Dividend stocks are still super cheap.
Caterpillar paid a gigantic dividend at an all-time high.
I mean, if you just look, this is just math. I mean, the top 20%, the top quintile of dividend-paying companies trade at a 30% discount to the S&P 500. So if you're worried about the growth picture and you want to rotate because you want to stay invested, own dividends. Own small and mid caps that are interesting when you see a broadening. Some are very interest rate sensitive, others aren't. Participate outside the U.S. Don't worry about where a company's domicile.
Yeah, look at your point about international. That was great.
You got to own it. Yeah. And the currency too. I mean, when this period of time sort of tails off and there's some resolution to this war, you're going to see some non-dollar strength again.
Yeah, I think you're right. But I'm not recommending Caterpillar for my compliance. I'm just saying it's a nice company that pays a big dividend. Let's not do that. Bond market. You have a lot of history in the bond market. And the bond market, as I said earlier, kind of going the opposite direction. Is it inflation, the size of our debt, or something more scary? If people ask me what I think a black swan is, if we just keep racking up debt, eventually it becomes a real problem for the United States.
So look, I agree with you in general. And when people talk about our debt, they have to talk about it relative to GDP. Our debt 50 years ago was a lot smaller, and so was our GDP, which I just mentioned. So they can't, the trillion shouldn't scare people, the T. Yeah. What should scare people is the percentage of debt relative to GDP, and we're significantly over 100%. That should be concerning. We need to get our debt deficits both under control, for sure. The bond market right now is not worried about the 30-year forward-looking picture of debt and deficits. It's worried about inflation. That said, the risk-free rate, if you look at the 30-year at 5.15, that is a super attractive level for 30-year bonds. So, and the 10 years 460. You add on spread, and even though credit spreads are in their richest quartile historically, you add on spread, you got investment grade corporates at 5.25 or 5.5. You got high yield at 7.25, 7.5. You blend them together, and you're talking about a bond portfolio in the 6s. Yeah. Not too far away from long-term capital market assumptions for stocks. Yeah. So you're getting equity-like returns in the bond market now. Yeah. So it's a super attractive place to enter and hold on and see through the noise. But if I would have told you 5 years ago you'd build a bond portfolio that's in the 6s, you'd think I was crazy.
Oh my God! Listen, my favorite line is Ryan's, my buddy Ryan over here, told me this. I call them bonds are sexy again. Because you can make some real income on these things, and you might even get price appreciation if things go we expect them.
Well, especially in this period where I think if the economy is going to be a little bit softer with this, you're going to want to own some duration. You could get appreciation, but I think if you just take your starting yield level as a good indication for 5-year forward-looking returns, you're mid-single digits for bonds. I think it's a pretty interesting place to own.
Yeah, especially if we can get past 1, maybe 2 wars, and we see this kind of deflationary aspect of AI or just enhanced productivity, you might just get a rate cut late this year or next year. Right now, it seems off the table because a new Fed chair, Kevin Morris, would really like one, but it seems like that might be a little hard right now. But I think you're right. I think that makes the bond market a really interesting place.
The Fed, though, if you're at the Fed, I mean, think about it. If you and I were sitting at the Fed, and there's so many good reasons we're not, but if we were sitting at the Fed, we would do nothing.
Yeah, nothing at all.
You can't do anything. Yeah. You can't. Inflation's high enough right now where it's really hard to cut. Yeah. And you're worried enough about growth where you really can't hike. There's a reason the market is pricing in very little for Fed funds in terms of change, because you can't do anything if you're at the Fed right now.
And in fact, in fairness, to be prudent, they should. You have a little dry powder if things get worse. I guess I'm a bit more worried about a hike than a cut. If this becomes systemic inflation because of oil, which I just don't think it does, then okay, maybe there's a chance and a hike would be really tough on the bond market and on the equity market. Let's have some fun and switch gears for a minute. You know, for years, I've grown up with the folks who invested in private markets, where the ultra and the high net worth. And there's a change happening. And I think it's fundamental that you guys are kind of the tip of the spear on this. And you have a partnership with KKR, which is amazing. Maybe for a minute, talk about what you all are doing in the public/private partnership world. And then more importantly, let's get to the second part, why people should use it.
Yeah, I think, you know, what's interesting in the private market, you know, environment right now is 12 to 18 months ago, there were some folks just creating FOMO. So I have to get into privates really quickly. And that creates sometimes a little distorted behavior. The principle is simply, historically, private markets can offer some diversification and higher total return if you're willing to deal with the illiquidity of private markets. People in pension funds have been benefiting from them for a long time. What about wealth management? So now the opportunities in wealth management are real. And I say there will be folks who have never participated, may never participate. And by the way, they'll do okay. If you look at the S&P for the last 30 years, it's compounded at 10% with dividends reinvested. People have done just fine.
Yep.
Can you see some weighting in a portfolio for private markets for folks in wealth management who've never participated? Sure. Could it be 5 or 10% of their portfolio? Can they own private credit? Can they own private equity, infrastructure, real estate? Are they going to be able to participate in some diversifiers at a reasonable, not unreasonable weighting in their portfolio? Because these are less liquid securities and fees are higher. So we entered a partnership with KKR. We put together 60-40 public-private portfolio.
60 equity or 60 private?
So in both credit and equity, it's Capital Group KKR, Capital Group 60, and KKR is 40.
Okay.
And people say, well, why'd you make Capital Group 60? And my answer was, it was higher than 50. and in all honesty,
you need some liquidity, right?
You want liquidity. Yeah. I mean, for us, we're doing public markets. It's more liquid. It's cheaper. So we just wanted to make it accessible. Accessibility comes through greater liquidity and a reasonable price point. And that's what these are. And we've had them for a year. The two credit ones we've had for a year. The equity one we launched a couple months ago. To me, if you've never participated in private markets, this is a very easy way to jump in, because you know it's more liquid than standalone privates. Yeah. You know it's cheaper.
You get quarterly redemptions most of the time.
Quarterly redemptions. And normally you get 5%. In our two credit strategies, we allow for 10% because it's a more liquid.
10 on those.
Because it's a more liquid portfolio. Yeah. So it's
is it a balanced type account? Or what does it add to a portfolio? Is it accretive to your equity side, your bond side, or both?
So if you look at the credit side, the way I would think of the public-private credit strategies we do, you see these charts that show sort of short duration, high quality bonds through core bonds, through high yield, and you go up to the right, this will yield higher than high yield, and it will be semi-liquid. So think about it in your fixed income portfolio. Think about it in the up to the right when you look at risk and yield. And I think for the equity side, you should think of it as an equity portfolio, but again, less liquid and growth equity. So again, on both of them, up to the right on risk and reward. And you shouldn't have a massive weighting in private markets regardless, but this is a good way to get your feet wet without jumping into something that's wholly illiquid that you worry about the gates coming up.
So let's kind of frame this out. I build a portfolio, traditionally 60-40, 60 equity, 40 bonds. In your opinion, just opinions between you and you, are we taking money from the equity side, the bond side, or both to slice this in?
So here, if you just own the credit strategy, I would look at the 60-40 and take it some from the 40 in the bond side. Yeah. Take it 5 or 10 from the bond side, make it 60, 30, 10. Yep. And the 10 would be in your fixed income mindset, in your fixed income weighting up to the right in terms of yield and risk.
Are you chasing yield with this? Is the idea of taking a little more risk to get a bigger yield? Am I going to get price appreciation? Am I going to get both?
Yeah, so I think it's more yield than price appreciation. And what you're looking to do is using fundamental research to out yield high yield by a little, not a lot. You're not taking unlimited risk, and that's important in the portfolio. We want to make sure it still gives you good income, but doesn't have too much risk. So I wouldn't say we're chasing yield. I'll say we're looking for heavily researched incremental yield that's reasonable, not unreasonable.
Okay. So a lot of times when I'm building portfolios, when we're managing a bunch of money, we do a lot with you all. We try to find ways to bring portfolio risk down through diversification. So I know this is going to get us a bit more yield. I know it's going to be a public-private investment. Will it diversify our portfolio further? Does it lower our portfolio volatility, or just more similar to traditional credit?
Look, if it's going to be a 5 or 10% weighting in your portfolio, it's not going to dramatically reduce risk, and it's not going to dramatically increase diversification.
Okay.
I think the 5 or 10% weighting is an acknowledgement, and this is both for the advisor and their client. This is a great education tool. Let me learn about private markets.
Yeah.
Instead of seeing someone at the soccer game who tells you they're invested in private markets, and you call your advisor and say, why aren't I invested in private markets? Take a breath.
Yeah.
Use a 60-40 hybrid to learn about the market, to learn about the liquidity, to watch how it does during distress times, to see how it does in total return, to see how it does in portfolio return. Just take a breath. I think the whole world has created this chase it mindset. And that could be with anything, prediction markets, Bitcoin trading on your phone. Like, what are we doing?
Yeah.
Take a breath, use it as an education tool. It's going to yield, the credit's going to yield a bit more than high yield. The equity is going to return a bit more than the S&P 500 over time.
Well, let's stop there for a second. Your equity piece, that one's fascinating. We're seeing a lot of companies wait to go public. SpaceX, we've had all this talk about what's happening in SpaceX. Is this the chance for the sort of the less sophisticated investor to finally get access to private equity and maybe be part of these gigantic IPOs, or is it, what does that piece fill? Because that one's even me a bit more fascinating.
Yeah, I think that piece, I wouldn't think of it as an Anthropic, OpenAI, SpaceX sort of look through. That's not really what it is. These are long-term companies that people may have held private. We're getting an opportunity to do it through KKR's private equity structure, KPEC, which is their own K-series private equity strategy. You'll have access to companies that you don't generally have access to, but I wouldn't think of this as the mega IPO precursor. I would think of it as a diversified private equity portfolio.
Okay. So you get into companies that are eventually going to go public, or just owning a piece of a company that's a very good private company?
Either or. Okay. And so it will be our 60% of the public equity market that you've known us for 95 years. And then KKR's private equity strategy. KKR was founded 50 years ago with private equity. This is their core flagship K-series private equity strategy that we put into our public equity strategy.
Why them? Why KKR? I know the firm is an excellent firm, good people, but from what I know, they're a solid Wall Street firm. What made them a good partner for you guys?
Culture. I mean, we had a deal team that went out there and assessed the capabilities of a bunch of different private managers. And one of the characteristics that they were rating these companies on was culture. Because for us, we're co-branding. When you say Capital Group - KKR Public Private Solutions, you've just added someone else's name in your name and your strategy. Culture is the most important thing. And everyone who rated them on culture rated them a 5 out of 5, except one person gave them a 4 out of 5. And their co-CEO, Scott Nuttall, said to me he wanted to chat with the person who gave him a 4. Like they pride themselves on culture. And when you get in bed with someone like that and you're co-brand, and you want to make sure you have heavy alignment on that. They also have a 50-year track record. I joke it would take us 50 years to recreate a 50-year track record. So they've done a really nice job over a long time for clients. They're focused on client outcomes. If you notice, Scott and Joe, the co-CEOs, they talk about clients. They don't talk about asset targets. We want to be $1 trillion. We want to be $2 trillion. Your clients don't care if you're $1 trillion or $2 trillion. They care how you're doing for them. And they focus on outcomes as opposed to asset raise. And I think between culture and their history and focusing on outcomes, it set them apart. And our diligence team came away and had them as number one by a long way.
So I don't want to leave this yet, but I want to frame this out for the folks who listen. They grew up with equities and bonds, and they probably never invested in something private. So I guess the answer to surmise this would be a chance to be in asset classes that might get you a higher yield, or access to private companies that you normally would. Is that fair to say?
That's simple and factual, and yes. And doing it through a 60-40 takes down the risk of a fully illiquid
right.
structure, where it's still quarterly liquidity, but obviously it's all private. So
you can be locked up in a private equity firm for forever, or a fund,
and some of them are the evergreen ones that do provide quarterly liquidity. But this is a way, in a very simplistic way, it's a way to participate. Think of it like training wheels. Instead of jumping in the deep end and no one taught you how to swim yet, it's training wheels, and you'll learn more about the private asset classes, and it's a good way to gain some diversification.
Sometimes say it's a private product, or private equity, private credit for Main Street. That's kind of,
yeah, I think that's a good way to put it.
You guys have been a disruptive firm for a long time, always doing things different. This is obviously emblematic of that. But you've also done something else to me, which is, wow, it took some guts to do it. You're creating, and now a big part of the active ETF industry. For a minute, frame out what an active ETF is, and then why you guys went there. I think it's changing so much. I'd love your thoughts on it.
Yeah, I mean, think about this. 30 years ago, when ETFs were created, they were only created as passive to track a benchmark. And for 25 years, the active industry just watched that and said ETFs are passive. And then our clients came to us and said, we love what you do in mutual funds, but can you offer the same thing in a more tax efficient vehicle in an ETF? And we still want your intellectual capital. We just want that investment vehicle, the ETF. So we launched them. And so you can have an ETF the same way you can have a mutual fund that's active or passive. You can have an ETF that's active or passive now. Now, active ETFs in the industry in the US are 12% of the total ETFs. But this year, 40% of the flows are going into active ETFs. So it's just a way to gain exposure of your favorite manager in a different vehicle than a mutual fund that might better suit your needs. We have seen so much interest. We launched them 4 years ago with no idea what would happen.
And let me set the thing. You guys are a multi-trillion-dollar mutual fund company who decided to do something that could impact your multi-trillion-dollar and go in a completely different direction. So sorry, go ahead.
No, I mean, it's important. For us, it was saying, how do you get our smart people's best ideas into clients' hands? Very simply. And the answer is, make sure you have it available in the vehicle their financial advisor wants. Yeah. It might be a mutual fund. Fantastic. It might be an ETF. Fantastic. You can't own it if we don't offer it. So it was a way to offer it, and I think that was critical. A few of us wrote down on a piece of paper and put it in an envelope. We said, how much are we going to have in 5 years or 4 years in ETFs? And we were writing 4 billion, 9 billion. None of us had any idea. This morning I looked, we had $140 billion in active ETFs.
That's incredible.
And so it tells us that clients wanted our intellectual capital. Some of them still wanted a mutual fund for them. Fantastic. We manage 2.7 trillion in mutual funds. People ask me, what's the future of mutual funds? I say they're going to be around forever, and they add value to clients' portfolios.
So you don't think it disrupts the mutual fund industry? You don't think it has a profound impact? I feel like it's such a profound shift that we're starting to see.
So mutual funds, here's what I would ask folks on. Clearly, the vehicle of ETFs is interesting to folks, and they're adopting it. We are seeing about $300 million per day into our active ETFs. Per day into our active ETFs right now, year to date.
Is it because they're cheaper? Are they better?
It's not a price thing. It's just an intellectual capital in a different vehicle. And the vehicle may be more tax efficient than your mutual fund, depending on if it's a retirement account, if it's not a retirement account. But the interest in them is so high. For mutual funds, with our 2.7 trillion still in mutual funds, do the markets go up faster than the redemptions go out and people look to ETFs as a place to invest? The answer has been yes. I mean, what's your capital market assumption? 7% for equities?
Yeah.
The outflow rate in mutual funds is nowhere near 7%.
Okay.
So the assets in mutual funds, our 2.7 trillion in mutual funds in 10 years will probably be 4 trillion. And our ETFs will be well over $1 trillion at that time, because they're growing faster with net inflows, for sure. But markets go up faster than flows go out in mutual funds. And for some folks, again, For A-share mutual fund owners, brokerage owners of mutual funds who have used that, it's been great for a long time. The longer they own them, the better they do in many ways.
Yeah.
That will be around forever.
Well, it's the capital system.
It'll be around forever, and you have other opportunities to participate in the active market through a tax-efficient vehicle.
Yeah, that's fascinating. So it really is more new money. And what we're seeing, to your credit, is you guys are offering choice. And for the folks listening, we've talked a little bit about this, but an ETF does something that's similar to a mutual fund, not exactly the same, but an active ETF allows you to still be a portfolio manager, picking stocks in there or bonds in that sense. And it's just a different vehicle. Right?
It's just a different vehicle. And the fact that 40% of the net flows are going in there, what it tells you is the existing base of 88 and 12% passive and active, over the next 10, 20, 30 years, we'll be retired. I will. I don't know about you. But over that period of time, you'll see that 88-12 go to 80-20, 70-30, because active ETFs are now available. There are opportunities for folks to participate.
Yeah. So that, I mean, in the world of disruption, whatever you want to call that, you guys are down a path of privates, which is new, and certainly ETFs and being active there. Let's switch gears for a minute before we wrap up. But two things that come to mind that I'd love your opinion on it is, someone that's, you are looked upon as someone who's a thought leader in this industry. How much does AI affect us? I mean, does it mean loss of jobs in this industry? Are people going to work with an AI bot to build a financial plan? Are we going to use AI to run portfolios? We hear so much disruption because of it. Think about what's happened to so many big companies, or excuse me, good companies. What do you think?
So I think it depends exactly what we're talking about. If we're talking about, is AI a general purpose technology that changes the way business gets done in a lot of places around the world and in a lot of industries? Absolutely. For sure it will, and it does. In the world of financial advice, an agentic AI agent has a very difficult time holding your hand when the market's down 20%.
Yeah. Not
a good job to reach out of the computer and hold Phil's hand. So the power of advice from financial advisor individuals spent their whole life working and they've saved money. Are they going to turn that over? They didn't do it with robo advice. It didn't happen. And they're not going to do it with AI agents saying, please run my portfolio. That AI agent doesn't know your kids, how much gifting you'd like to do in your life, how much you'd like to leave your kids, how you'd like to think of trust and estates. How are you thinking about insurance? How are you thinking about the markets when they go down a lot and why you should stay invested in the long term? It may say, here are some things you should contemplate. And AI can do that today. This conversation between us and the conversation between one of your advisors and their clients is so important to have, that personalized advice, that customized advice, getting to know the family. My financial advisor has advice and dinner with my kids all the time. I don't want them sitting in front of the computer doing that. I want them having a relationship and talking about things. So it will impact the way all of us work and workflow. Will it displace financial advisors, the 300,000 in the US who are out there providing advice and helping people in that way? I don't think so. I think it's going to be an and in terms of efficiency, not an or in terms of using that financial advisor to help you manage your life.
I think the more time I spend with the young folks I get to work with, and we manage money for, and how we manage money, I try to help them understand it's a great tool to help you make a better decision. But don't let it make the decision for you.
100%. You said it better than I did.
If we could just get folks to understand that, then I think we get to a better, smarter way to manage money and have more effective ideas around do you need tax management? Do you need a portfolio, or do you just need a holistic kind of approach? That I think would be amazing if we get there. I'm just worried about along the way I'm going to shut off the rest of the world and just use AI. I think it's a very
I think for financial advice, that's going to be very challenging. And I think it's through when you need that advice most is when you would miss it most.
Yeah, I think you're right. I think is it a job disruptor? Is it going to take away jobs? I mean, I've read Javodi, if I'm getting the phrase on Geron's paradox, I think it's called. This is something you guys today. Anyway, it's about how we're going to add more jobs. Right?
So everyone has a different view on this. There's no right answer to that. Will it disrupt industries and jobs? 100%. Will it create new jobs? 100%. What is the net effect of those two things? Time will tell.
Yeah.
I think the people who speak with great passion about knowing the facts around that massively overestimate their knowledge. I really don't think it's a brand new thing for so many folks, and how it plays out over the next 10 to 20 years. It will be very disruptive. The nature of the balance of creation and destruction of jobs and changing jobs, we're all finding out more every single day. Be careful of someone who's sure they have the answer on it.
I agree. I read a piece that said in 1995, the expectation was that Microsoft Excel came out. It was going to eliminate accountants because it was going to make things much more efficient. Today we've got triple the number of accountants than we did in 1995. We added more nothing.
Yeah, you got to be very careful of any new technology in terms of the long-term impact. It will be impactful. It will probably be even more impactful than people know. But the net outcome of all that will be something that will be interesting to watch.
I think it's a long way to go. All right, crystal ball time. Just for fun. If you had to say what you think the next 5, 10 years look like in finance, what major changes could you see, or what do you want folks to take away from today if there's something to think about what's to come?
Yeah, I mean, I always like to put it in, because folks who are listening are thinking about their money and how they should think about investing. So I boil it down to a very simple hierarchy of returns. If you look over the last 30 years, and I use 30 years because during that period of time, we had the dot-com bubble burst where the S&P went down 50%. And we had the global financial crisis where the S&P went down 50%. So in 30 years, you had two periods where the stock market halved.
Yeah.
During that period of time, cash returned 2%, bonds returned 4%, MSCI ex-US, so the international markets returned 6%, the broad world returned 8%, and the S&P returned 10%. About, give or take a little bit for your compliance funds. But 2, 4, 6, 8, 10. So back to where we started in terms of cash. There is no extended period of time where cash wins. It's a fear trade, and it's an overestimation of one's capability to time markets. So stay invested. Don't look at the market every single day. Let someone who's a professional do that for you. Have someone help you. DIY in finance is not a good idea. It's the same way in medicine. It's not a good idea. It's not a good idea in finance. Have someone.
That's why we have the podcast to help people at least understand. Don't make a mistake that's going to hurt you long term.
Yeah, and get some advice, for God's sake. I mean, you know, I'm gonna go in to have my hernia removed. I love you, Phil, but I don't want you doing it. Like, no thanks. So get a professional to do it, but learn that being invested over the long term and not trading in and out of markets, we got to get rid of this meme mentality.
Yeah,
we just got to get rid of that. We got to get people saying, the longer I'm invested, the better I do.
I agree. I think what I get from folks who listen to this podcast a lot is they want to come away with understanding what's happening in markets and just not panicking. So we can get them to not do that, and then stay invested, meaning no, don't panic, don't take your money out. Yet we still see trillions of dollars in cash today. And then just private accounts alone, 7 to 8 trillion in cash.
Here's a crazy stat for you. And this is for people who are just interested in long-term investing. The Investment Company of America. We've managed that for 94 years. If you put $10,000 into the S&P in 1934, now this is the Great Depression, 10,000 into the S&P in 1934, today it would be worth about $170 million. Oh
my gosh.
If you put that into the Investment Company of America, it'd be worth $460 million.
That's incredible.
By simply outperforming by a little over 100 basis points a year for 90-something years. So it tells you stay invested, look for active returns that can beat benchmarks over the long term. Don't try to trade that. You could have said World War II's here. It's the end of the world. I'm going to trade out of it. Yeah. I'm going to trade out of it because the energy shock in the 70s or the global financial crisis or COVID. Anytime you could have said no, and the S&P is just off its all-time high right now.
Yeah.
So just stay patient and stay invested.
And this is why Capital Group is the premier investment company in the country. You guys have been an incredible company for a long time, incredible returns, a consistent year after year. But I think your message is what's most profound, is that for folks, if you don't panic and you stay invested, you can have it's the greatest way to create wealth. I mean,
over the long term, for sure.
This has been fun, buddy. Thank you.
Always. I'm glad you invited me.
We got a special moment now. We got to wrap up today. Shout out of the week. I can go first if you like, or you can go first. Anybody you want. Could be family, friend, or something.
You go first. Your show.
So I have two. This week. I usually don't do two. I'm going to give one to my cousin, Jason Gillis, who finished his first 10K ever. He trained, he ran, got it done in an hour and 12 minutes. Not exactly speedy, excuse me. But we got it done. And sure enough, to his credit, you know, it goes to show you, you could change in life. He's in his 50s. He's never run before. To get out there, put on sneaks and get it done. And I made a bet with him. I said, I'll tell you what, don't give up. Let's come back next year to Cleveland. And we did a little walking. Let's try and run this thing the whole way and break 10 minutes. So we put a goal out there. It's exciting.
That's great.
And the second one, coming up on Memorial Day, I can't help but, you know, just kind of remember the folks who have died for the United States. You know, the military folks who have done everything they can for us to give us this incredible country, the freedom that we have, the capitalism that we have. Hopefully we'll take a moment this weekend and celebrate those who have sacrificed for us and give us the country that we have today. So my hats off to the military of the United States.
All right, I'll do two because you did too.
Please.
My niece today is graduating from a program at Columbia in psychology. She's wonderful. I love her. I can't wait to have dinner with her tonight.
What's her first name?
Samantha.
Okay, she'll listen.
She's great. She'll listen. And then like you said, every year for this will be the 13th year, I support a veterans charity called Catch a Lift. So look it up, Catch a Lift. And they support wounded veterans. They do an amazing job. We've had this New York City event for 13 years. We're having it this Thursday ahead of Memorial Day.
Wow. And
it's helped over 10,000 wounded vets get back to physical health and mental health after being wounded in the service of our country. So I always have a shout out to them, both the charity and then the folks they help for doing so much for our country. That's
amazing. If you're listening in, can the folks who have listened donate to something?
Yeah, I mean, go on. I think it's catchalift.org and go on and read about the mission, importantly.
Yeah, for sure.
Read about the mission, but give to these folks, someone who's willing to go out there and risk their lives. We're not doing that every day. These folks are.
Yeah.
And there's a lot of trauma that they incur. And so us remembering, regardless what you think of any war, the folks who are in it, we should take care of them as much as we can when they come back.
I think that's amazing. I like that. Buddy, it's been a pleasure. Wanted to do it.
Appreciate
Thank you very much.
Thank you, Phil.
Everybody have a wonderful week. We'll talk to you all soon. Thank you.